Welcome to the Threefold Real Estate Investing Podcast. This is the podcast where you'll not only learn how you can achieve massive success in multifamily real estate investing, but also how you can simultaneously pursue great relationships with your family and a better walk with God. You can achieve financial freedom through real estate investing without sacrificing the relationships that mean the most to you. Now, here's your host, Lee Yoder.
Hey, Threefold listeners, I hope you're having a great week so far. Today's Juneteenth, so maybe a bunch of you had today off. Hope you had a great Father's Day weekend, especially for those fathers out there. I know I did. My family treated me to a little camping this weekend. My wife asked me what I wanted to do for Father's Day, and I looked at the weather, and we got such a nice reprieve from the 90-degree weather we had last week and the 90-degree weather we've got coming to us this week. It was down in like the mid 70s over the weekend here in Southwest Ohio. So we went camping. We got to do some canoeing, some bike riding, and then just some good tent camping, cooking over the fire, stuff like that. So today I wanted to do something a little bit different, what some people call a solo cast, I guess, where I'm just going to be talking. I had an interesting, I've been thinking through an interesting topic. I'm sure a lot of people are thinking through this right now, and that's just what to make of this market. And then obviously the question is, for those of us out there looking for real estate, wanting to get into real estate, wanting to invest in real estate, whether it's actively or passively, you're just wondering, is now a good time to buy? Is this a good time to invest in real estate? A lot of people are asking this question about a lot of different investment classes, right? So stock market's down, depending on which sector, whether, NASDAQ, the S&P, they're all down at least close to 20%. I think the NASDAQ is closer to 30%. If you're in Bitcoin, you're down around 70%, I think. So, and some of the other altcoins, even more. Now, real estate is not down, but I will say, and we'll get into this more, but some prices are down a little bit. Housing doesn't seem to be down in price. It does seem to be cooling off a little bit, at least in our area and others that I hear from. But it's an interesting market. And then, I haven't even got into rising interest rates. That's obviously a big reason for this rising interest rate. The Fed is now decreasing their balance sheet. Some people call that quantitative tightening. And then inflation is raging on, right? So Powell said it was transitory. Turns out to not be so transitory. Maybe it'll cool off sooner rather than later. And maybe that's still considered transitory if it was just high for a year. But anyway, all these things make you wonder if now is a good time to invest in real estate. And so I want to address that today, kind of give just my opinion, the way I'm thinking through this at least. So maybe you don't care that much about my opinion, but maybe you'd like to hear how somebody like me is thinking through this. And then maybe you can kind of take this and go talk to others, listen to others. I would highly recommend that and think through this for yourself. So I want to start with an email that I got from a good friend of mine. She's also an investor. Her name's Julie Holly. She emailed me and asked a great question. And as I was trying to answer this question to her, thinking through this myself, that's kind of what I'm going to do here on this podcast. So she asked me in an email, do you think deals that pencil out now, but are not, robust returns, still decent, do you think those kind of deals will end up performing well over the next 5 years as financing changes and inflation takes its toll? Okay, so the financing, the increasing interest rates, and the inflation. How am I looking through, a decent deal? How will it perform? Thinking about those two things. So everyone, this is a great point she makes. Everyone wishes they would have bought more in 2020, but 2020 was a scary time, right? But looking back now, you'd have been almost anything you bought in 2020 is worth more today. So her question is, will we be saying we wish we would have paid top dollar in 2022 a few years from now? So we look back a few years from now and say, man, that was a good time to buy because things, went up even more. And the way I think through this, the way I answer her is I think you got to address three topics. You got to answer three questions. The first one I want to address is inflation. So I really think you have to answer this inflation question. Does inflation rage on? We're at 8.6%. We've been right around there for the past few months. Do we stay up there? Most people think we're going to drop at least a little bit, like we're going to start coming down. But I really think what you have to decide is, do we start coming down like to 8 and then 7.5 and then 7? And by the end of the year, we're still at 6 or 7% inflation. That would be really high for a long period of time. Or are we down more like to 3 or 4% by the end of the year, which the Fed was predicting? They've kind of walked back on some of that. But are we down to like 3 or 4% where we're still high? That's, 50% higher to 100% higher than the Fed's target inflation rate, which is 2%, that would be very different, right? So I think you got to think about that and kind of nail that piece. The reason I think you need to know that is because my next point, or the next question you need to answer is the Fed going to continue raising interest rates? Are they going to stay on this aggressive rate hike path that they're currently on, this path that they say they're on? If you look at like the bond market, the treasury market, and how they're predicting where the Fed's going to end up, they think they're going to raise all the way to 3.8%. Right now, we're still, I think, between 1.5% and 1.75% is where the Fed funds rate is. And that's important, especially when you're getting into commercial real estate and you're looking for lending, because they base their interest rate on the Fed funds rate. It'll be like 2.5 times or 2.5 percentage points higher than that. So if they're at 2, they're going to lend out at 4.5. Right now, they're more like at 5.5. So will the Fed continue raising interest rates aggressively like they have been, or will they slow down? Will they start to see the economy kind of hurting, things slowing down and seeing enough pain? I mean, already, like I mentioned already, what some people call risk assets, the stock market, and then even riskier assets like cryptos, things like that, they've been hurt very badly, right? So the Fed is seeing that. I don't think they love that. They obviously have shown they don't care that much so far, but do they continue? And then I'm already kind of getting into the third part, and that's that. Do you think we're headed toward a recession? And how bad do you think that gets? Because I think depending on how bad the recession gets, depending on how quickly and drastically we slow down and we see GDP dropping, we see spending decreasing, maybe we see unemployment start to rise for the first time in a long time, right? Because we've just seen unemployment tick down, like to where we're basically at the point now where most people would say we're fully employed. And, then they throw out this stat, and I don't know what to make of it, but there's, 10 million job openings and 3 million people unemployed. So there's 3 jobs for every person unemployed. I don't know that I believe in all of that, but still we're basically fully employed right now. But do we see that start to go in the other direction? And if we do, and if we see a lot of pain, and we're getting close to midterm elections, right? I mean, the Fed is political, in my opinion. Do they start to turn around? So you can see how each of these points, each of these topics, each of these questions that I'm asking kind of build on each other. And that's why I think you need to answer those questions, because when you're trying to decide if now is a good time to buy, I think what the Fed is going to do is very important. I think whether or not we're headed to a recession, how long and how bad of a recession will it be, these are very important things, right? You can kind of see that. So before I get into kind of how I see things, I'm going to work through these things and kind of give you my answer on whether or not I think now is a good time to invest. So I think inflation is going to come down pretty quickly, actually. The main reason is I think demand is decreasing very quickly. I think we're already seeing that, and I think it's going to continue quicker than most people think. So already, you look back at some of the earnings reports and some of the forecasting that the Amazons and Apples and Targets and Walmart even, they are saying that things are slowing down. Spending is decreasing, right? And so they're predicting that their future earnings are lower. And so their stock prices are way down, right? So some awesome companies, they're not going anywhere, but they were overvalued because spending and then their earnings are going way down. And so I think we're already seeing that. I think it's going to get a lot worse. I think with how high oil is right now, food prices, and then everything, right? Because if oil is high, and now, the people that are delivering the goods, their input costs are higher. Your prices on everything are going to go up. So we're seeing that. And then that's what inflation is, right? So I'm already I'm kind of building out what inflation is. But I think all of that starts coming down because I think the consumer can afford it. And so maybe you've heard people say the cure to high prices is high prices, because as prices rise, eventually the consumer can't afford those prices. So they stop buying. So you have to decrease your prices if you want people to keep buying. And in some cases, I think there's just going to be less things being sold because there's not as much getting delivered. And now you hear of maybe some truck companies shutting down so they can't even deliver. So I think even though supply is still low, so a lot of times you just look at supply and demand. Oh, well, supply is low, so demand is going to be high. And I agree with that most of the time, but I do think this is a rare situation where supply is going to be low, but demand is actually still going to be low. So like, look at cars, it's still low supply. They're still not making that many cars. There's still a chip shortage, all these things, like you're not getting that many cars, but demand is still coming down. So I think prices come down. I think sales come down. I think things slow down. I think inflation comes down quicker than most people expect. another big part of why I think spending is going to decrease and has already decreased so quickly is because we had so much money injected into our economy, not just from the Fed. That's not technically money printing, but from our government. So from these handouts, from these stimulus checks, from allowing people not to pay their mortgage, still allowing people not to pay on their student loans. So even though it's not handing out money, it's telling people they don't have to spend money over here, so they can go spend it over here. You don't have to pay back your loan. Most people don't just save that money. Now, savings did increase a lot during those times. People did increase their savings, but that's come way down. And now people are already starting to increase credit card spending. So now that all these things are coming back, and now you do have to pay your mortgage pretty soon, potentially, you do have to start paying on your student loans. Now you can't spend so much on other things. You're spending more on gas. You're spending more on food. You can't go spend as much on other things. So I think we start seeing a slowdown. I think inflation comes down. I think we are headed for a recession. I think both of those things do cause the Fed to turn around. So to answer that second question, I kind of already answered the first and third, a little bit on the third. But that second question, I think the Fed slows down pretty soon. I mean, and pretty soon, I think 3 to 6 months. But I think they absolutely slow down. And instead of 75 or even 50 basis points, I think maybe they go to 25, maybe they skip one. And I think they stop decreasing their balance sheet by the end of the year. So I think by the end of the year, we're in a recession. Inflation is down maybe more like 4%. And I think the Fed has stopped raising interest rates, stopped decreasing their balance sheet. So now they just keep it the same. So they buy just as much as rolls off their balance sheet to keep that level. I think they pause. And then I think there's a chance the Fed starts decreasing the interest rate again and increasing their balance sheet because we're in a recession. And that's what the Fed does during a recession. I want to pull up a chart here real quick. Jay Scott is a guy a lot of you probably know from Bigger Pockets. And he's really sharp on the economy and all these things. And he posted this great chart that I've heard other people talk about and seen other people post. Hopefully you can see this. If you're listening, I'll explain it. It's from the FRED database. That's the Federal Reserve site. But this is showing the federal funds effective rate. So what we're talking about, the Fed raising interest rates. So they've raised interest rates a lot of different times. And Jay Scott shows with this chart that he pulled up from the FRED, that the Fed has raised interest rates. They raised it back in the 80s. They raised it in 90, right before the dot-com bubble. They raised it right before the great financial crisis. They raised it. And what happens? We have a bad recession. The stock market tanks. Real estate, usually is affected. And then they lower interest rates. They drop them like we were raising before the pandemic. And then we had, so yes, did the Fed cause the pandemic? No, but I think we were already headed toward a recession. So anyway, this is just another example that they lower them. So now they're trying to raise them again. Now they're not very high. I get that. But actually, if you look back, another interesting thing is every time we raise interest rate, every time the Fed has gone on this rate hiking cycle, they get to about half of what they were to do before. And this is a whole nother topic, but this just shows you the kind of debt we've taken on and how our economy cannot handle higher interest rates. Because you go back to the 80s when we were battling this inflation that we had throughout the 70s, we got up to 20%. Okay. Crazy. And then they raised it in the early 90s, or maybe like right around 1990, we got up to 10%. Okay. So only half as high on the Fed funds rate. Then we raised it heading into the dot-com bubble. We got to like 6%. So again, half. Then we raised it going into the great financial crisis, and we got up to like 5%. So actually there we were kind of about the same. And then when we tried to raise it before the pandemic, and actually we had already started decreasing interest rates again before the pandemic. So it wasn't that. If you can remember, Trump was really upset that the Fed was raising interest rates, and stock market dropped like 20% at the end of 2018. And that's when Powell, they call it the Powell pivot. That's when he turned around. Then they were only able to raise it to 2.5. So again, half of where we were before the great financial crisis. So now, again, we're up to like 1.5. So we're already up to about, and maybe I'm overshooting a little bit. Maybe we're only up to 1, but we're close, 1 to 1.5. We're almost to half of where we were before. So again, that's where I think maybe we do get to 2.5, but I don't even think we get there before they pivot. So I think we're headed for a bad recession. I think the Fed pivots. I think they start decreasing interest rates again, actually, and that might not be till next year. I think they start increasing their balance sheet. So all those things being said, I do still think it's a good time to answer my friend Julie Halley's question. I do think it's a good time to continue to buy real estate. And I do think we'll be happy we did in a few years, because I think in a few years, inflation will be down. I think the interest rate will be down. So when we are refinancing or selling, I think we're doing that into a lower interest rate environment, which typically means higher asset prices, right? Because we've seen this here lately. Prices are coming down a little bit to match the increased interest rate, because now your debt is more expensive. You can't pay as much, right? We're going to start seeing that in single family, I think. But if interest rates are lower a year, 2, 3 from now, then I think we're going to sell for higher. So that's what I think is going to happen. That's how I think it's going to play out. So I do still think it's a good time to buy, because I think we're headed for a recession. I don't think it's a severe, horrible recession like the great financial crisis. And I don't think it takes as long to come out of it, because I think the Fed learned from what they did in 2020 versus what they did in 2008. And what was the difference? They increased their balance sheet by about $4 to $4.5 trillion in, I don't know, a year, versus in 2008. I mean, everybody freaked out because they didn't print, but they increased their balance sheet by $800 billion. That's when the Tea Party started, because everybody was so mad about that. And that was historic back then. That was a crazy amount back then. But we end up, building our balance sheet up to, something like 4 trillion, but it took like, I don't know, 5, 6 years to do that. I think what they learned is, hey, we can just do it super, super fast. And this is not good. I don't think this is good long-term for our country and for investments, but I do think it makes everything bounce. Just like they did during the pandemic. I don't think it's going to be that significant, but I think things are going to bounce. I think, prices come back up and go to new all-time highs 2 to 3 years from now. So that's my take on that. That's how I think through that. I think hopefully, whether or not you care how I think through that, and whether you agree with me, it just kind of gives you some ideas of, I think, some of the questions you have to answer and how you need to think through that. Another thing I'll say is that I like to think, obviously, through what if I'm wrong? Right? What if inflation stays high? To answer that question, and the other way, if inflation stays high, which it definitely could, the war rages on between Russia and Ukraine. That has a lot to do with supply chains, right? And has a lot to do with the price of oil. So I understand all those things. Yeah, maybe demand kind of stays elevated, or maybe it comes down a little bit, but it doesn't matter that much because supply is that low. So there's still enough demand for that, very low supply, and prices stay high. So inflation stays high, all those things. That could totally happen. If that does happen, I still think we're headed for recession, because I think this recession is really driven by this inflation. So I think if inflation stays high, we're headed for an even worse recession. And then I think the Fed is in a really tough spot because inflation is still high. So you need to, bring up interest rates to combat that inflation. That's really the only thing they can do. It doesn't do that much. I don't think the Fed has near the control a lot of people think they have, but they know the one thing they can do to combat inflation is increase interest rates, because that decreases demand. But when we're headed into a recession, and maybe it's even worse if inflation stays higher for longer, they don't want to raise interest rates. In fact, they probably want to cut interest rates to help with the recession. So I think it puts the Fed in an even bigger bind. But I still think they at least stop raising interest rates because I think they're going to be, too worried that the economy's in too rough of shape, and companies are going to start failing, with raging inflation and higher interest rates. So I still think they can't do that much. If they keep raising interest rates, then what we bought this year, what we're buying this year, maybe interest rates are higher 2 to 3 years from now. So to, I guess, combat that, or to prepare for that is a better way to say it, we are locking in interest rates for 5 years. So we usually go get local lenders, local banks to give us fixed rate interest for 5 years. We try to get a shorter prepayment penalty so that if we are ready to refinance or sell in 2 to 3 years, we can do that. So we want just maybe a 2 or 3 year prepayment penalty, but we want the interest rate fixed for 5 years. So again, that gives us 5 years to find a spot where the Fed decreases interest rates, where we can sell or refinance. But even if they don't, we'll have paid down enough debt. We'll have increased the value of the property. We can still refinance or sell and make a great profit. Will we do as well as we would have if interest rates were lower? No, we won't. But likely we could hold on a little bit and maybe catch the Fed when they do decrease interest rates. So even though I think interest rates are lower, and I think the Fed raises a couple more times, but then I think interest rates are lower even than they are today, a year from now, 2 years from now. If I'm wrong, we have the runway with our the kind of lending we get to hold on for a couple more years when I do think they'll be down. If we're still wrong, sure, we're not going to hit some of our projections. We're not going to do as well likely, because I think asset prices will be down if the Fed's fund rate and then interest rates in general are still higher. But I don't think that's likely. So to answer my friend Julie's question, I still think it's a good time to buy. Maybe with a recession, you could buy even better 6 months from now. I think that's very possible. And likely if that happens, we'll be glad to buy then as well. But I don't try to time the market. That's too hard to do. There's been so many times I thought we were headed for, a correction and we were going to be able to buy better. And like Julie said, maybe in 2020, in 2020, I did think that. I did think prices were going to go down more. And we didn't buy anything in 2020. But then we bought in 2021 and I wish we'd have bought more in 2020. So you just can't time it. So if you think you're going to get a better deal in 6 months, maybe you hold out, but I wouldn't hold out too long because again, you just can't time the market. You got to buy smart. That's a whole nother podcast episode. You got to buy good deals. You can never get away with bad, or you never want to try to get away. Sometimes you can get away with buying bad deals. If you bought in 2020, 2021, you probably got away with buying bad deals. Heck, really any time in the past 5 years, you can probably get away with it. But with interest rates going up, it definitely makes it a lot trickier. So you got to be smart. But that's how I answer those 3 questions. What's inflation going to do? What's the Fed going to do? And are we headed for recession? What's that look like? I think you got to answer those 3 questions to answer whether or not you want to buy commercial real estate like apartment buildings like we do here at Threefold Real Estate Investing. Hope that was helpful. Reach out to us if you have more questions. Obviously, I love talking about this stuff. I talk about it to myself all the time. I love to talk to other people about it as well. So reach out to us. You can check us out at threefoldrei.com or reach out to me at info@threefoldrei.com. Hope you guys have a great week. See you next time.
Thank you for joining us for another great episode. I hope you'll take action on what you've learned today. If you enjoyed today's show, please consider leaving Lee a 5-star rating and review. And check him out on threefoldrei.com. Until next time, 1 Timothy 6:17.